and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a journey towards my financial freedom. We'll cover financial products and financial well-being so you, like me, can reach your aims sometime in the future. Now let's get into this latest video. So this video is about creating a portfolio which will give you passive income, hopefully, let's just say £1,000 a month moving forwards. So first of all, how do you create a portfolio to reach that goal? Now, £1,000 a month may be out of the reach for most investors who are new, but break it down into bite-sized chunks. Now, it may appear psychologically impossible, but we need to break it down into sizable amounts. It may be first when starting out, you may be able to invest £25, £50, £100 a month, or what you can afford. It may well seem daunting, but buy what we call fractional shares, fractional funds, and we all need to reinvest the dividends we receive whenever they're paid out. One thing you need to discover though is the so-called eighth wonder of the world, what we call compound interest, whereby your portfolio will start off relatively small and it will grow and grow and grow and build momentum. As more money is added into it, the portfolio will grow at a later date at a substantial rate. Now, the aim of what we call passive income is so your portfolio grows in the background day or night, and it doesn't need any work or control or monitoring. You can just switch off and it will earn money moving forwards. Whereas working a 9-to-5 day job, you are limited about what you can earn because you are trading your time for money. So how do we get started on this journey? I personally use a website to help me called dividenddata.co.uk. It's free. It will provide information and details about what dividends are paid out by companies, showing the dates of payment, and the current yields and the past histories. The website is simple to use and it tracks shares in both the FTSE 100, the FTSE 250 and investment trusts. Another handy website I use is through my current platform provider, and they produce what is called a quarterly report called the Dividend Dashboard. It's only a few pages long, a quick PDF you can download, but it does provide details about the market report, dividend payers, largest yields, and a list of so-called consistent companies that pay out of the last few years and how those companies have performed. Now, they provide details whether it's been reduced or increased in the last few years, and again, it is free. You can use them whether you've got an account with them or not. So that is on the AJ Bell platform. It is called the Dividend Dashboard. Now, my portfolios are mainly UK based. So as a comparison, I will use the FTSE 100 as a benchmark. Currently pays out a yield of around about 4.12%. Now, out of the 100 companies, 95% are paying dividends. And a quick comparison, the FTSE 250 is giving a yield of 3.42%. So on that basis, you would need to create a portfolio of around about £300,000 to produce £12,000 a year, or £1 per month on an average basis. Now, across my four, what we say, investment accounts, which being Trading 212, my stocks and shares ISA, my investment club and my SIP account, I do receive dividends averaging over £1,000 a month. Okay, so if I can do it, you can do it. It just proves it is possible. £1,000 is attainable. However though, for today's video or today's purposes, I will keep it simple and I will show you the figures and charts with regard to one of my accounts, my stocks and shares ISA. If we look at the following graphic and figures, we can see how the portfolio has grown over the past few years from very humble beginnings to now being worth nearly 6 figures in value. And each year it has grown in value because we've added more funds to it, but also it's grown because we received the dividends. Now, we started off relatively small. The first year of note, we received less than £200 per year. And then at the moment, we received £1,501 for this year to date, and for next year, on current payments this year in place, we will receive over £2,000. So it just goes to show, in a small period of time, we've gone from under £200 to over £2,000. Now, the dividends paid out are all tax-free in a tax-free ISA wrapper. They are all reinvested into the account. So next year we will receive a larger dividend payout, and they will grow faster and faster through the power of compounding, and they will all be reinvested into the portfolio. Now, with regard to this portfolio, we're only recording the dividends received from 9 shares. So although the portfolio is worth £70,000, only £26,000 is of shares. We've done it because it's easy to track. Now, those shares are giving us a yield of around about 5.87%. And the funds within our, or the amount within our funds and our ETFs, are all in what we call accumulation units. That all proceeds are reinvested automatically back into the fund, and the fund price will increase. One thing of note though from the chart, we did see a reduction during 2020. Now, this was because of the COVID scenario. In the UK, because of the pandemic and the economic situation, the government put a restriction on the banks not to pay any dividends due to the uncertainty. So that's why in 2020, our dividends were reduced during that year. Let's dive into the portfolio and see what sort of companies I've invested my money in and what shares I am buying now on a regular basis. Now, I'm looking for shares with good dividend cover. So above 1, it means it can pay out a dividend from existing profits. It's not using cash reserves. But personally, I am looking for dividend cover of around about 2% or better, which will give it a margin of safety if a company does suffer unexpected results, poor trading, or who knows, another economic unforeseen circumstances. So the first company of note is Legal & General, ticker signal LGEN. Now, it's paying out a yield at the moment of 8.35%, and it has a very nice dividend cover of 1.85%. It did pay out a final dividend in June of 13.27 pence, and it's just paid out an interim dividend of 5.44p, so a total dividend of 18.71 pence. And it's currently trading around about £2.20, so as I said, a yield of 8.35%. Our next holding of note is Sainsbury's the retailer, ticker symbol SBRY. Now, it was paying a yield of around about 4% when the shares were trading over £2, as they have done during the most of the first few months of this year. Unfortunately though, recent weeks they dipped in value. They're now trading around about £1.70, mainly because of market sentiment, lack of consumer confidence in the market. So it has increased the yield up to 7.75%. It does have a very good dividend cover, of 2.27%, and it's paid out the following dividends this year. So an interim dividend last December of 3.2p, and a final dividend in June of 9.9p, so an annual dividend of 13.1p. Now, it'll be interesting to see what happens when results are out in the next few weeks. Does it increase dividends in December? And just of note, Tesco's results last week, it did increase their dividend. So hopefully Sainsbury's will do the same. But as I said, it was trading around 4%, now 7.7% because the share has dropped in value. But it could be a great opportunity to buy a share with a very good deal at a very attractive price. Another safe company is Aviva, ticker symbol AV. Again, it's paying the yield around about 6.22% and has dividend cover of 2.27. Now, it has increased dividends lately, and it did pay us a special dividend earlier this year, and it did do a share consolidation. But we're only recording what we call normal dividends. So in May, it paid out 14.7p as a final dividend, and in September, it's just paid out 10.3 pence, so an annual dividend of 25p. Now it's trading around about £4, so the yield is at 6%. Now it will increase dividends over the next few months. Okay, it's already stated that as part of a recent restructuring. And just like L&G, insurance providers are very cash rich. They receive steady income from premiums. Now they may be considered safe, boring, but ultimately they are very reliable and dependent shares, and they have not reduced their dividends over the past few years. And our final share of note is NatWest Bank, currently paying a yield of 4.79%. Again, very good dividend cover of 2.42. Now it did pay out a dividend in May of 7.5p, and it did pay out a dividend in September of 3.5p, so an annual dividend of 11 pence. Again, it did some kind of share consolidation. It did pay out a special dividend, but we've not took into the factors. Now the bank is back in profit. It is still owned by the government, but it's now less than 50%. So as it's being reduced, the shackles are off. It can increase in dividends. Okay, it is not restricted by the government. So hopefully dividends in future will be increased, as it is a very cash-rich and profitable business. Now, other shares we own in the portfolio are Lloyds Bank, HSBC, and Barclays. We do own AJ Bell, the platform provider, and we do own one share which is not paying dividend, which is Card Factory. Okay, so out of our portfolio, 8 are paying shares, giving us a yield of 5.87%. Now, Card Factory was very cash rich. It did pay an interim dividend, it did pay a special dividend, but it was temporarily suspended because of the COVID scenario, and it took out some kind of banking covenants and restrictions. It is expected to resume to pay dividends back again in 2024. Okay, so hopefully dividends will be increased with that portfolio. Now, at the start of the video, we did say it may seem daunting, but think of it in stages. Your initial aim may be £10 a month or £100 a year. Learn about the power of staying consistent, where you make regular contributions every month, okay, in a tax-free wrapper, and all your dividends are reinvested back into your portfolio, so you, like me, can reach your aims and goals. If I can do it, you can do it. Remember, if you like the videos, smash the like button, subscribe to this channel, and we'll see you again in the next video.